Today, I thought we'd do a little bit more of a focused discussion about why you should max out your retirement accounts. Retirement accounts are awesome. If you talk to people, they're all interested in some sort of an account that will give them easier estate planning, better asset protection, pay less in taxes, get their investments to grow better, and facilitate rebalancing. But what they don't realize is they already have this account available to them. It's a tax-protected retirement account. And they come in a couple different flavors, right? Obviously, you have 401ks, which are tax deferred, and you have Roth 401ks and Roth IRAs, which are tax-free accounts, meaning you put after-tax money in there, and then the earnings are never taxed again. Those are the two main flavors of them, but whichever one you choose to use, either way, you are almost always better off than investing in a taxable account. Now, a taxable account isn't all bad. Most of my investments now are actually in a taxable account. That's been a transition for us over the last 3 or 4 years as we've gradually moved things out of our tax-protected accounts into our taxable account, just because its proportion of our overall investments has grown. It's not all bad, right? You get the lower capital gains rates on long-term capital gains. If you get qualified dividends out of there, those are also taxed at a lower rate. You can donate appreciated shares to charity instead of cash and flush those capital gains out of your portfolio. You can tax loss harvest, as we've discussed. But overall, these benefits pale in comparison to the benefits of using a retirement account for your investing. So whenever you can use a retirement account, please do so. The downsides are not very big. For example, there's the age 59 and a half rule, but honestly, there's so many exceptions to that rule, including using the SEPP rule, substantially equal periodic payments rule, to get that money out penalty-free before age 59 and a half. You just have to basically take out the same percentage of it every year for at least 5 years, and you're allowed to do that. So even early retirement in that respect is an exception to the age 59 and a half rule. So really not many downsides at all to using these accounts. Now, granted, sometimes an employer offers a crappy account. It's got crappy investments in it. The fees are super high. But even then, you're still usually better off using it for the tax breaks. And so we're seeing fewer and fewer of those. I think people are getting the picture, the employers are getting the picture that they are legally responsible to not have a crappy 401k plan, that literally they can be sued by their employees because they have a fiduciary responsibility to them in that respect. And so I think those accounts are actually getting better over time. But you need to understand, particularly for a typical doctor, why your 401k is so awesome. Okay? We're all worried about getting sued above policy limits. It rarely happens, but we're all worried about it. Well, you can actually keep what's in your retirement accounts after declaring bankruptcy. So say you get sued successfully, the chances of this happening are super, super low. But say this happens and there's a $10 million judgment brought against you. And what do? You declare bankruptcy and you get to keep what's in your retirement accounts. So that's a great reason to max them out. But beyond that, a 401k gives you a tax break up front. If your marginal tax rate, meaning the rate at which your next dollar is taxed, is, let's say, 40% between state and federal, if you put $10,000 into a tax-deferred account, you just knocked $4,000 off your tax bill for that year. It's a wonderful benefit, right? Now, the skeptics will say, well, you're just deferring those taxes. But that's not entirely true because you get a couple of other benefits in there. The first is that while that money grows, it is not taxed as it spits off capital gains and dividends each year like most investments do, or spits out interest. You don't pay taxes on that as it grows. So the money actually grows faster inside the retirement account. And the second benefit, well, there's another benefit. You can rebalance in it. It costs you nothing to buy and sell in the account, right? There's no tax consequences of doing so. So it's easier to rebalance your portfolio as well, or switch investments if you didn't do a very good job selecting them, or if you just need to move things around. When I have to make changes in an account, I try to always do them in my tax deferred accounts. But the last benefit is one that a lot of people don't understand. And that's the fact that you will almost surely, if you are a typical doctor, you will almost surely take that money out of the account at a lower tax rate than you put it in. And that is not a prediction of future tax rates, right? If tax rates go up, that doesn't mean you're taking that money out at a higher tax rate. And the reason why is that taxes fill the brackets. So as you have taxable income in retirement, a certain amount, if you're married, I think it's $24,800 or $24,600 this year is the married standard deduction. So if your only source of income in retirement is this tax deferred retirement account, your only source of taxable income anyway, obviously Roth IRAs and that sort of stuff doesn't count. But if your only source of taxable income is this traditional tax deferred retirement account, the first $24,000 plus comes out tax-free. So if you saved 40% when you put it in and you took it out at 0%, that is a huge arbitrage between those rates. And it's a great benefit of that 401k. Now, beyond that, the next 19,000 or so comes out at 10%. The next 50,000 after that comes out at 12%. The next 75,000 after that comes out at 22%. So all of this is coming out at a much lower tax rate than when you put the money in. So this benefit of being able to fill the brackets is a huge benefit of being able to use a tax-deferred retirement account like a 401k or a cash balance plan during your peak earnings years. Now, there are some exceptions. They're typically super savers that have multi-million-dollar IRAs and all this other income coming in from their side businesses and these side gigs they've got and, a bunch of, investment properties and that sort of stuff. It is possible to actually have a higher marginal tax rate when you pull this money out than when you put it in. But for the typical physician that saves up a $2 or $3 million portfolio to retire on, that is not going to be the case. You're going to take that money out at a lower tax rate than you put it in. I think it's important to understand that tax-deferred retirement account is likely your biggest tax break. It is absolutely huge. If you're in private practice and you've got, a setup like mine, for instance, my current setup at my partnership is I can put up to $57,000 into our solo 401 or our 401k profit sharing plan. And right now I can put another $17,500 into a defined benefit cash balance plan. For most doctors, a deduction like that, being able to deduct $70,000 or more, $75,000 off your income is huge. That's probably your biggest tax deduction. It's bigger than your interest deduction. It's bigger than your charitable contributions. It's bigger than your mortgage interest deduction. It's your biggest deduction. These days, some docs that are in business for themselves might have a substantial 199A deduction. This is the pass-through business deduction. But those are basically the two biggest tax breaks out there. So it's important to understand, if you're looking to pay lower taxes, the best way you can lower them is saving more money for retirement and doing so in a tax-deferred account. Now, there are different types of retirement accounts for different types of people. If you're an academic, chances are good you are offered some combination of accounts like a 403B, which is very, very similar to a 401k, as well as a 457B, which is a little bit different. It's actually deferred compensation. It's technically your employer's money, which has asset protection implications in that it's protected from your creditors, but not your employer's creditors. You might also have a 401A. That's typically an account where it's only employer money going into it, or they have a mandatory contribution from you, but works similarly. And so if you're an academic, you really need to understand the accounts that are being offered to you, how they work, and how you can maximize their benefits. If you're in private practice, you probably have something more similar to what I have, a 401k with a profit sharing plan, plus minus a defined benefit cash balance plan. Remember, if you're in a partnership, you have to use the partnership plan. You can't just go open your own plan. If you're getting paid on a K1, you can't go open a solo 401k with that. Even if you incorporate your business, right? Even if the partner is actually your corporation, you can't just go open your own solo 401k, which is kind of interesting because the way this recent PPP loan, this forgivable loan that they were giving out in response to the pandemic, that actually didn't work that way. If you had your own corporation, you could actually apply for your own, which was separate from the partnership plan. Remember that a true independent contractor, right? You're paid on a 1099. You can use an individual 401k, which takes a lot of the hassle and expense out of running a 401k program. You can go to E-Trade or Vanguard or Fidelity or whoever you want and open those up. You can even get self-directed ones. If you have two types of income, for example, if you're a W-2 employee at a hospital and you also do some moonlighting, you can have more than one 401k. You just need to make sure you stay within the rules. right? If they're completely unrelated employers, though, you can have a 401k for each one. But despite having multiple 401ks, you still only get one employee contribution. This year it's $19,500 for those under 50. There's a catch-up contribution for those who are 50 plus. However, you can make up the rest of that $57,000 per 401k per employer limit with employer contributions and also with after-tax employee contributions if the plan allows it. So the way this typically works, if you have a couple of 401ks, is you put in your maximum employee contribution at the hospital 401k. They give you some sort of match, a few $1,000s, maybe $10,000, and that's what goes in that 401k. And then in your individual 401k, it's 100% employer contributions, which works out to be about 20% of the net earnings for your side business. So if your side business made 50 grand, you can put about $10,000 into there. And that's how you use more than one 401k. Just keep those two contribution limits in mind. The first one is total for all the 401ks is your employee contribution. The second one is your per 401k contribution. That's the $57,000 limit. I mentioned employee after-tax contributions to 401ks, and this is getting to be a more and more common feature in a 401k. This is what we call the mega backdoor Roth IRA, because what you end up doing, assuming the plan allows it, is even above and beyond your $19,500 employee contribution, you can put in after-tax money. And some plans allow you to convert that within the plan to a Roth 401k. And obviously you didn't get a deduction, so there's no tax cost to converting it to a Roth 401k. Some plans require you to and allow you to take the money out of that account, put it in a Roth IRA, and obviously do a Roth conversion that again has no tax cost. Because that limit is so much higher than what you can typically put into an IRA each year, they call it the mega backdoor Roth IRA. But that can be a good option for a number of people. There are a lot of complex uses of it. But the bottom line, if you're trying to get more money into retirement accounts, that might be a good option for you. There's always a backdoor Roth IRA for yourself and your spouse. If you're under 50, it's $6,000 a year for each of you. You put it into a traditional IRA. You then convert it to a Roth IRA with no tax cost because you weren't allowed to take a deduction for the original contribution. And then, of course, one of my favorite retirement accounts isn't even labeled a retirement account. It's the health savings account, or what I call the stealth IRA, which is a wonderful account. It's a triple tax-free account. You get a tax break when the money goes in. It grows tax protected. When you pull it out, it comes out tax-free as long as you spend it on healthcare. If you take the money out and spend it on something else, you have to not only pay the taxes, but you have to pay a penalty. And that penalty lasts until age 65. After age 65, if you pull the money out and spend it on whatever you want, you just have to pay the taxes on it. So in that respect, it's no worse than your 401k. Thus, we call it a stealth IRA. So if you have access to an HSA because you use a high deductible health plan, be sure to use that as well. As a general rule, that benefit of that money growing in a tax-protected way is so advantageous that you don't really want to take money out of a retirement account until you have to. So anybody that's telling you pull money out of your retirement account, they're usually going to cause you to make a mistake if you follow that advice. And, usually if the answer is you're worried about having a whole bunch of taxes down the road, the usual solution to that is not to pull the money out of the retirement account now so that doesn't happen. The solution is to do Roth conversions so that money isn't taxed when it comes out of the retirement accounts. So I hope that's all very helpful to you. I hope that was kind of a deep dive into retirement accounts. I hope you're using it. I hope you see the benefits of maxing them out.